I'm sleepy. They try knockouts. This is my third consultation call with Trade Brigade, and this is episode 3, part 1 of the new series I am making, Trade Brigade. And in this video, Trade Brigade is going to be showing us his understanding and awareness of the certain days where you should have more faith in a given trade and don't stop out and dump your positions too early, and on the days where you should have less faith in just get out, be done right there. And part of having faith is learning how to take profits properly and use the market internals on a given trade to see how much strength the market has in the direction that you want the market to go. This is very true because I'm currently on 5 consistently profitable months in a row, and now I can even see it for myself with certain days where I'm more willing to hold compared to other days where I'm just looking to get out. Or even just stop out early, to where some people might even call it premature. But there's certain days where you got to hold and just sit tight, stay patient, and allow the trade to do its thing. But again, there's days where the market you should do that and days where you shouldn't. So again, don't take this just from me. Yes, I have 2 years of experience and I have gone through many ups and downs, and I am a consistently profitable trader now. However, I'm juggling this gargle from somebody that actually knows what they're talking about, from Trade Brigade, who has over 12 years of experience. So please understand, take this at your own risk and learn how to do it properly and find what works best for you. With that being said, let's get into this video. Don't forget to like and subscribe to Day Trader Knockouts. Stay safe, stay green. Peace out, my fellow millionaire day traders. I need to go sleep. Bang. But I got so many more to record.
Cool, man. Absolutely. Take it away. You want me to share my screen, or do you want to take over the screen, or we'll just do it over conversation and I'll share it when it's relevant? I think that'll work.
Yeah, that's fine. I don't think I have to share my screen. It's just questions I have to ask.
Cool. Then I'll share mine so I can possibly make some comments on whatever those questions are. So, all right, you should be able to see it now, I believe, right?
Yeah, I see it.
Cool. Awesome. All right, take it away.
So, let's see. So the first one was just the general, what can I do to stop my, I already got that question out the way. That's basically the whole premise of this meeting now. I guess, the first question here, which was actually what I was talking to you about from last Friday, was what could have kept me in on the trade, because I was looking at market profile, just to make it brief. My stop loss was because we started off with kind of an open drive. I guess you could say sort of was an open drive, sort of, because we never broke the opening print after we started moving up. Now, I stopped out the moment because it shows here on the market profile, it shows A, B, G. So the G period came back all the way down to where A and B overlapped each other, but it never went back to the A single prints. So I just wanted advice, maybe from that type of perspective, what could have kept me in on my call trade for that day. So that's one question.
Gotcha. Yeah, let's take that one. Let me pull that up here, and we'll dive into that one for just a brief moment before continuing along, because that one really focuses on one specific instance. So let's have a look at that before we move into possibly some broader concepts that we can then apply to some other stuff. So bear with me as I get that pulled up. And this right here is what we're talking about. So this is Friday right here. And so this lower wick is kind of what took you out, right? Right in here.
Let me see what candle. On a 5-minute candle, I stopped.
This is a 30-minute chart. Sorry.
Oh, 30. Oh, yeah. Okay. Well, I just want to real quick look at my account statement to see what time I stopped out at.
Sure.
So, today is the 8th. It was the 5th. So I bought it at 10 o'clock exactly, and then I stopped out at 12:50.
Gotcha. Yeah. So that would be the pullback in this 30-minute bar. And the reason I pulled up the 30-minute chart, of course, is to sort of compare to market profile. So in all honesty, stopping out of that trade was probably the right idea. Let me go to a 5-minute on another tab here so we can actually see the entry. Did you say, what was it? 10?
I entered, let me see. I entered the exact time was 10 o'clock, 10:00:51. I don't know how to say
gotcha.
that.
Yeah. Right in here.
Yeah, because I told myself I don't remember what the whole context was. I have to look up my whole pre-market, but that would be a whole other topic. But just generally at this point, with whatever my analysis was, it was about like an opening drive. I told myself that, if the B period has a break above the A period, that's when I would enter with a decent stop loss. And I was playing off Friday rules, and on Friday rules I have lower deltas, so
Mhm.
I'm not risking as much.
Gotcha. Yeah. Okay. So I mean, everything. Seeing the trade on the 5-minute chart, to me looks just like an equal high break, basically, from that perspective, right? And that's almost the same idea behind B period exceeding the highs of A. Just that equal high continuation type move. So entering in here, I think, like, for the most part, Friday was interesting because it's a gap green over red, right? And then also it's a look below and fail. So there are a lot of dynamics specifically on the Friday trade that made it a little bit more difficult to, I would say, stay in this instance. And one of those would have been just like, to me, I thought that this possibly was going to offer a lower high, right? Something that did, or at least a double top or something like that. Just because the market, in my estimation, it was trying to make a breakdown the previous day. We know that things were pretty bearish from the FOMC. So I really wasn't looking for a long kind of up here at this break until we got a break through 410.35, and then it was okay. Can we get higher lows back above that level? So from a 5-minute candle perspective and like execution perspective, I would have said that if that was the trade you were going to take, your trade basically unfolded right at the opening of this bar, somewhere in here. That's like 10 o'clock on the nose and 51 milliseconds or whatever it was. So in this instance, there's two things that I would be thinking about. Number one is you still have to contend with that break, right? So maybe it was like it was probably as the market was moving higher was your entry. I don't remember, minute by minute how that was unfolding, but based on what you were saying, the breach of A period highs acting as the entry point, it's basically looking for that. So in that instance, there's two places that I think would make a really reasonable stop on this time frame. If you're using Friday rules and you're like lower risk, just kind of, gonna let this thing unfold, the number one stop would have just been under here, right? And
Yeah.
then, and so as you're entering, right, you've got to think about, all right, this is kind of like my risk. I'm willing to just let it chop around in this pullback area. When and if it starts to break, we'll look to go with it. And of course, you were going with it in here. So stop, entrance, and then target, some pie in the sky sort of number, just looking for continued squeeze as the day unfolds.
I had a specific number. It was the Wednesday high, the top of the wick of the candle.
Top of Wednesday high. That would have been the FOMC volatility, right?
Yeah, it was like
Up in here.
418.57. Yeah, that right there. It got close.
Yeah, I mean, you're pretty spot on.
Yeah,
with the ultimate move.
Yeah.
Yeah, I mean, again, all things considered, the trade idea, the thesis, the thinking behind what you were doing there is all correct. This little lower wick is kind of the thing that's the pain, right? So there's, like I said, there was a reason to possibly stop out of the trade at this area, considering what was already going on, right? You did see some continuation. If you weren't selling into this strength and saw this pullback unfolding, you're probably like discouraged, and rightfully so, that the market was just not doing anything impressive. It's a Friday. We're going to look for like things to chop out. This move that happens here into the close on Friday is kind of like, I don't want to say it comes out of nowhere, because it does come off of a technical hold of support here, which was really the breakdown point, right? This 410.35 has been just such a key level for the S&Ps. So the hold of that kind of produces this as sellers perhaps realize they don't want to be short into the weekend. So in hindsight, it looks like, yeah, okay, this was kind of obvious, holding up at 410.35. But in real time, as this market is breaking back down underneath, I don't necessarily think that you made the wrong decision here by stopping out. What I suppose would be the difference is, at that point, your stop was, were you trading weekly expirations? Were they expiring same day, 0 DTEs?
No, I don't do that. I always
okay, good.
My rule is always if it's Monday through Wednesday, I'll trade the contracts that expire later in the week, like Thursday, Friday. If it's Thursday, Friday, I'll trade contracts that expire like next Wednesday or something.
Perfect. Okay. So if there were zero DTEs, as we know, like you got to be in and out of those things quick. So you should have been selling into strength here. Because you did have some extra time on your side, something that you could have done, like adjusting the stop loss to your entry point, because basically that's what I'm assuming took place, right? You adjusted stop break even as this unfolds, and then it kind of takes you out in here. Is that correct?
Yeah, so sort of, yeah. Well, really, to make it brief, my stop loss at first was like a little bit below, like if you could just put your pointer like right there where the pullback, yeah, there.
Mm-hmm.
I gave it a little bit room below because I understand we're in a choppy market and I was okay with taking that loss. That was the first
Mm-hmm.
thing. But then I adjusted it looking at the market profile saying once it touches the space where it hits the A and B period overlap, that's where I'm stopping out.
Gotcha. Which would have been right around in here.
Yeah, where
Yeah.
exactly where the spike. And real quick question in regards to that, uh, in a situation like that, should I be waiting till it hits like the single A prints or the AB, or is it just something that's kind of subjective?
It's a little bit subjective, but in this particular instance, there is some alternate place where I would have recommended a stop, specifically noting that this was a day trade, right?
Mm-hmm.
Um, and that was kind of going to be my next point, which was here. See the hammer low from. Let me zoom in on this. See the hammer low from right here. That
Mm-hmm.
that area to me would have been like the logical stop, because what's happening is the market's kind of one time framing, making just higher lows, higher lows, higher lows, right? You get no sort of intraday, there's no overlap to the downside on the profiles if you're looking at them as a split profile. Um, so this would have been the next area where I would have placed a stop right underneath those hammer lows. And we're kind of splitting hairs here between here and here. But nonetheless, again, the logic of the trade as this is unfolding would tell us that we would have gotten stopped out anyways. This move down in here was kind of a nasty move. And, again, unless you were selling into this strength, this fade was kind of lackluster. So, seeing this massive rally into the close, it's painful in hindsight because you're like, damn, you get that FOMO of like, I was in the right direction, and there's this monster rally, but all parts of your trade thesis were kind of telling you, underneath these lows, back down underneath the breakout point, a little bit of a hairy area to be. Like it's a reasonable place to stop out. So there's only two ways that this would have been a trade that you held all the way into the move. Number one is that the trade was sized for zero, right? And you were just willing to get into these contracts and let it ride, see what happens on the day. This was working. We're still technically above that 410.35. It's really just that annoying lower wick that sweeps the stops. So sized for zero, you just kind of hold on and you're like, okay, it's either going to fade off. And if we get a lower high underneath, maybe I stop out then because, why bother sitting in these things? Or if it holds above, then sure, it was a test. You'd probably be back at break even. Again, your entry was the 10 o'clock bar right on this open, basically somewhere in here.
Mm-hmm.
With theta decay, that's probably a break even, right? Maybe even a
Yeah.
small loss at that point.
It was a small. I lost like $9.
Yeah. So it's not a career-ending loss, which of course is always a good thing, right? It's just the shiny object syndrome that this rally looks so substantial, where you're kind of having that feeling of like, oh man, I wish I should have been in that. So at the end of the day, just to kind of sum it up on this particular trade, I think you did the right thing anyways, and you stayed disciplined by stopping out when you kind of needed to based on your rule set. And even like if I were in this trade, which I wasn't, I was in Tesla on Friday. Even if I were in this trade, like my stop would have gone here underneath these lows and I would have been stopping out around the same area anyways. So again, the only two ways that you could have stayed into this for this rally was sized for zero. Don't care if it like kind of wicks around support. You really, when you size something for zero, it doesn't mean that you let it go to zero, but you're just not as stubborn about a stop loss. So you might have waited for like a stronger break underneath, a lower high, and a new trend to be developing underneath 410.35. That's number one. And then number two would have just been like, okay, your stop remains at the original place down here. Entry is still here, and you just need to hold this into your target. Up there at the Wednesday high, which you were looking at, which did offer, right? The ratio on that trade is fantastic, right? If you do something like this, that's clearly a trade worth taking all day long.
Yeah.
So the only two ways, sized for zero or respecting the original stop. And one of the things that I think is worth doing is until you've until you've mastered the strategy and the market context via internals. And again, strategy could be a broad number of things. If you play fake breakdowns, if you play breakouts, doesn't really matter. But whatever the strategy is that you're implementing most, when you master that and market context, put those two things together, market internals, profile, all that stuff sort of illustrates, how aggressive is the day, basically, because it's fully worth noting. If we take a look at the market internals here, that Friday really wasn't, it was okay, but it wasn't like, it wasn't all, at least, now what am I saying? Where are we? No, what was this? What was this day?
That
Perhaps I'm misremembering, but actually, in hindsight, yes, Friday was solid.
yeah, that's right. Yeah, the next one's Monday, I think. Yeah, or so. I don't know.
Yeah. This of course is today.
Yeah.
Okay, so in hindsight, that's weird. I thought, which day? Anyways, maybe it was Wednesday.
I remember
one of the days was weak.
Yeah, I remember on the Friday session, the vol was crazy high.
Yeah. Okay. So then in that instance, right, the market context there would tell you that you probably don't want to adjust your stop loss up because the market was so strong, right? You want to have more faith that ultimately the trend will prevail if the internals are screaming in the upward direction, for example, right? So if the ratios are, I don't know, they were probably better than 5+ to 1 or whatever. If they're like that, then you usually don't want to adjust your stop loss on a favorable trade like this. But back to what I was getting at, aside from like mastering the strategy and the context via internals and market profile, oftentimes the best thing you can do for your data set of trading, like as you stack up different trades in your journal or wherever you log them, if you just keep position size consistent in terms of dollar amount being risked on every trade, and then that obviously is an indication for position size, but if you keep the stop loss consistent as well, and what I mean by that is adjusting it, right? Because if you enter the trade on the premise that this 3-to-1 is obviously going to give you a favorable risk reward ratio, right? As soon as you adjust your stop loss to here, what you've effectively done is you've skewed the risk reward ratio. Because now technically you're looking at, I don't know, whatever that would be, a multiple of at least 2 times, if not maybe 3 times the reward for the risk that you've now taken out of the trade. So because of that, you won't really have a fair assessment of whether or not the original idea would have been profitable, right? Over the course of, let's just say, a log of 1,000 trades. If you're constantly adjusting the stop loss, then the original strategy that tells you to put the stop here because the risk reward is favorable, now all of a sudden it's not being reflected in that data set. Because if the stop was here, then the trade would have worked out, and now you would have had a successful trade instead of a small loser. Do you see what I mean by tracking and keeping that consistency? The only time to start adjusting the stop loss is when you have a runner in favor that is so substantially in the money that there's more risk of keeping your stop loss at the original place versus adjusting it to lock in some sort of gain, right? What that would look like would be, let's say that this is the original trade coming back to these highs, right? So let's say that, in here, your risk reward is still favorable because you have this up here. At that point, this is your risk if you get stopped out, and this is your risk if you make the trade work or you hold into that target. Let's say that in here, the market starts pulling back. Now you can see that it would make sense to adjust your stop loss when the trade is this far in the money, because technically what you're risking is this versus this much potential reward left on the table. Does that make sense in terms of how it changes as the trade is unfolding?
Yeah, no, I completely understand what you're saying. I even tried to create a rule about like when it gets so far up in the money and I've made so many profits and I'm so close, where it's like, I would adjust my stop. I get what you mean.
Because at this point,